On Thursday, the 29th, the bond market broke its streak of negative opens by being up a whole 5 basis points early. Yay! Though it did rally 8 basis points while I was writing my morning post. Bonds began the overnight session in slightly stronger territory and made some headway around 3 a.m. Eastern Time on global concerns over China's COVID surge. Yields bounced higher in European trading, but found support heading into domestic hours. Yields blipped higher for a few seconds following jobless claims data, which are now came back down quickly. Jobless claims came in up 9,000 to 225,000 versus a 225,000 estimate. So it is right on estimate, though. The jobs are holding strong despite all the Fed moves. Continuing claims were up 41,000 to 1.71 million as 1.67 million previously. Seeing investors rotate into defensive names such as utilities and consumer non-discretionary stocks ahead of an expected recession in 2023, the bright side is that the next phase will be early stage cyclicals, which include financials and home builders. 2023 will start out as downright awful for housing. However, the second half could be brighter, especially if we finally see a pickup in home building. Come on, home builders, stop being so pessimistic. Like I said, started the day up small. At the end of the day, we're up 30 basis points on the day, which was welcome. After climbing 2% per month in spring and summer of 2022 and 1.5% per month in spring and summer 2022, in September of 2022, month-over-month rent began falling. Since 10 of 22, all major rent indices have shown month-over-month rents falling, with the declines increasing and by well more than seasonal norms. In November of 2022, national rents declined by about 0.66%. In a preview of coming attractions in December of 2022, rents will turn negative in Phoenix and Las Vegas. That was from econ70.com, and it was dense with information. I had trouble saying it. Which just brings us into the last trading day of the year, December 30th, 2022. Modest selling all night in Europe and Asia as the Bank of Japan unveiled an unprecedented third day of unscheduled bond purchases. This accelerated at 8 a.m. Eastern Time. Not sure what or why or something happened to accelerate things. Probably just somebody with a lot of money woke up and had an opinion. President Biden did sign a brand new $1.7 trillion spending bill last night, so that's going to put a lot of money and a lot of more bonds into the marketplace, as Barry B pointed out. So the government has spent the entire year lamenting inflation, doing all these Fed hikes, that on the last day they're going to pump $1.7 trillion into the economy. Oh yeah, that'll help inflation. MBS were down 16 basis points on the open. U.S. equity futures declined in the final trading day of 2022 as financial markets close out the worst year in more than a decade for global equities and bonds. The index has lost a third of its value this year as tech stocks emerge as some of the most vulnerable to rising rates. We also today got the Chicago PMI, which came in at 44.9 on a 40 average. Or on a 40 forecast. It was 37.2 previously. This normally isn't a big market mover, but we don't have a lot of volume, so market moves on easier things, and there just isn't a lot of data, so people need to do things. There's probably some people closing out some positions for the year. The early close trading session at the end of any given year is notoriously volatile. As always, the volatility, good or bad, but today's shaped up to be bad, being down 50 basis points. So at the end of the year, the MBS 5.5 is ending at 100.11. That's 100.11, which is basically barely above this 50-day moving average, which is the black line. And it's a very narrowing range. You can see a convergence of a whole bunch of ranges. So we have if we look to the most extremes, it's 99.845 to 101.037. So the technicals are really converging on themselves. The 10-year yield opened this year at 1.628 and never really looked back, running to its peak of 4.226 in October. Now likely to close out in the high threes, so it did close out at 3.88 for the year. Inflation rose year over year from 7% to a record high 9.1 in June, with the Fed implementing 4 75 basis point rate hikes, followed by the last 50 basis point hike earlier this month. Consumers felt the pinch at the pump and grocery bills, with food items rising anywhere from 5% for fresh vegetables to 20% for eggs. So looking into next week and next year, dad joke, we have a market closure on Monday. We got some construction spending on Tuesday, but the real market movers are on Wednesday, which will be the ISM Manufacturing Producing Managers Index, which normally isn't a giant mover, but we saw today that it can move the markets. Then on Thursday, we got jobs. We got ADP and jobless claims. And then on Friday, we get non-farm payrolls and another PMI number. So those will be the days that the market can do some moving. So I hope you have a great weekend and a happy new year. Be safe out there. And if you have some time and you're not hungover, check out our common sources and influences, including our sponsor at WellThatMakesSense.com. Start doing your planning for 2023, because the second week of 2023, we're going to have a series of posts that start with the best method I've seen to date on how to plan your year to get your goals accomplished.